Whew. What is going on, guys? Welcome on into today's stream. I'm sorry I'm jumping in a bit late, but it's been a bit of a challenge today. First off, we've got this going on my right hand. I'll talk about that at some point later on. But the Fed just raised rates by 25 basis points, and the market is going up. That was what was expected. We're going to get Powell in a half hour. The more important part, let me just adjust the desk and all that stuff, is Jerome Powell. So we're going to have his press conference. He's going to get grilled, I hope, on some tough questions. And so the initial reaction, these days are always kind of crazy. Initial reaction is a spike up. We got over 400 on SPY. Now we're sitting here around 399. Pretty much flat on the day as of right now, but we'll see where we're at post Powell. So just getting things started. It's the first time back streaming in like a week. So I know it's been a little rusty, but a couple things I want to pull up as we get going. But the Fed just raised rates by 25 basis points, and their statement says some additional rate increases may be appropriate. That was essentially what they said. Now we're going to get Powell's whole speech. I got the site pulled up here. This is where they're going to have the press conference when he comes on in a half hour. Or so. So we'll check the audio and all that in a second. I think it's working. That's what was taking so long. I think it's working good. We've had problems in the past, which is why I want to make sure that it is working good. So that's the deal. Yeah, we're live. So market popped up a bit here, up around 400 on SPY. So we're up about a quarter percent, just like the Fed raised rates about a 0.25%, or a 25 basis points. So yeah, well, it's going to be fun to see what Powell says. I think that's a big question of the day, and just, for this FOMC meeting and all that good stuff. We are expecting, let's see what else we have in terms of data. Tomorrow, jobless claims and Bullard speaking on Friday. Durable good orders. Nothing insane. So the biggest thing everyone was kind of questioning and looking for for today, right, is, what is the Fed going to pause? And they did not pause. And they're kind of you can look at it a couple ways. People said that they're in a lose-lose, right? The lose-lose meaning that, hey, like if they pause, that means there's bigger problems, and that's not good. And if they hike, well, they're making matters worse, and we're going to have more bank issues, and we're going to have more problems going on later on. So that's kind of where people are at. Now, here we go. SPY is pushing up. So the first initial reaction is up nicely. In terms of, let's look at yields. The 10-year yield down initially off of this. Now, here's the thing. The 10-year, if you go back in time, the 10-year is, kind of coming into these lows. It did just undercut the lows in the 10-year yield, and then it kind of bounced, really under 3.3, and you're breaking down substantially, probably going towards 3 next. So we'll see. Let me see if I can pull up the actual Fed statement. Give me like 2 seconds, and then I'll have that pulled up, and then we can look at that really quick. And then we can get, we'll be ready to go for Powell, right? So let's see. Here is the link. Let's pop it up. Here is their official statement. So pretty short, nothing crazy on this statement, right? So recent indicators point towards modest growth in spending and production. Job gains have picked up in recent months and are running at a robust pace. The unemployment rate has remained low. Inflation remains elevated. Yes, we are aware. U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses, and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain, and the committee remains highly attentive to inflation risk. So essentially, they're kind of saying that, this is the way I'm taking this, is we're aware of inflation risks, sure, fine. But this whole banking stuff, we're expecting to see tighter conditions for people, right? Which will then weigh down businesses, earnings, and economic activity, all that stuff, hiring, and that's going to pull inflation down. All these things are coming down, right? And that's kind of their view, which is probably why. Now, they're not pausing. They didn't pause today. They did a 25 basis point hike, but it's probably why we get a pause very, very soon, because they're expecting these kind of concerns and things to kind of really the lag of that stuff to really kind of fall into the economy and hit the economy in the coming months, and that's why they're probably not as worried. They're going to keep saying inflation's high and that we're aware of it, but I don't think that they're going to be as worried about it, right? As maybe they have been. It might not be the forefront of their discussions, right, anymore. So, Committee seeks to achieve max employment and inflation at 2% over the longer run. In support, they decided to raise the target range for the Fed funds rate to 3 3/4 to 5%, 25 basis point hike. Committee will closely monitor incoming information and assess the implications for monetary policy. Committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In determining the extent of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy lags with which monetary policy affects economic activity and inflation and economic and financial developments. Okay, there's the bank news. So take it all into account. More problems, probably slowing down, probably pausing soon, right? That's how I read that. In addition, the committee will continue to reduce its holdings of Treasury securities and agency debt and agency mortgage-backed securities. As described in its previously announced plans, the committee is strongly committed to returning inflation to its 2% objective. So in assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that can impede the attainment of the committee's goals. Again, that they have more than just one goal, right? Really, it's not just inflation, right? The job market, they have a lot of, there's a lot more price to, but there's a lot of things that all kind of bake into their job, right? It's not just, oh, inflation just goes 2%, do what you got to do to get it there, and that's it. It's not that simple. Committee's assessments will take into account a wide range of information, including readings on labor market data, inflation pressures and inflation expectations, and financial and international developments. So there you guys have it. That's it, and that's the Fed. That's their FOMC statement, but we got Jerome Powell press conference coming up soon. Let me just double check the volume on this. Give me like 1 second to pop this up. Hope you guys are doing well here. I see nice rally. Yeah. So far so good, I guess, in terms of upside in the market, if that's what you're looking for. But again, this is it's a risky time, right? No matter what you want to do, it's risk, because you're going to get Powell to come in. Now, ideally, we kind of see from a perspective of like, okay, if you're going to trade this is the first reaction. Ideally, you want to fade the first reaction and we do this. Will we get that today? We'll see. But the first reaction is usually a fake out. It's been choppiness. We've seen times where we do this and then this and then this. And back up. We've also seen the opposite where we go this and then just right back down, right? So we've seen it all, right? And really, it's a gamble no matter what if you're betting on before. And the good news is I guess not good news. The bad news for option premiums and stuff is that, if we go up, the VIX comes down and we're going to get some decay in those premiums. So let's look at the VIX. Let's go to UVXY. UVXY, get a good feel how that's doing. So UVXY hit a low, bounced a little bit. It's around $5 or so. The VIX has been kind of coming down. The dollar, look at the dollar. Whoa, big move down on the dollar. Check this out. I'm going to go to the 1 hour chart. Big move down on the dollar. Not back down to lows of the year, but getting pretty darn close, right? And about $2 away on the dollar. DXY. 10-year is down to 3.54%. Let's give it a second to load up. 3.54, not to lows of the year, but within striking distance for sure. SPY's up about 0.3% as we speak right now. So let's check that audio. Let me know how it sounds. It's just some like light. Actually, you know what? They've screwed me with that before. Let me just see if I can pull up some other audio. Some no copyright audio, because I've gotten screwed with that in the past. Give me like 2 seconds. No copyright music. All right, check this out. This is from YouTube, right?
Searching for music for your next video? Then you need to...
You'd assume that it should be good, right? We'll see. All right, check this out. Let me know how it sounds. It's kind of random. I can adjust potentially if needed. Sounds good. Okay, cool. Okay, I'll pause that for a second. You should get some. I did buy that. I'm probably an idiot for not using it. I paid for like Epidemic Sounds at some point, so I think I'm paying like yearly or monthly on that. I don't use it enough as background music, but I should. So yeah, so we're good. So we got that pulled up. Check this out though. This is I wasn't here when this came out, so I didn't see it until today. I just pulled it up today. But this is the AAII sentiment survey. So essentially just kind of gauges sentiment in the market. And we had a pretty bearish report come out. No, I'm not surprised. Like, are we super surprised that it's bearish? No, like, right, let's be honest. Because you've got the bank issues going on, right, all this stuff. You kind of feel like people are this lose-lose. Fed raises rates, more bank problems, more problems in the future. Fed lowers rates, or cuts rates, or pauses. Oh shit! Like, things are not good. This is the problem, right? Like, that's kind of the double-sided sword here of like a lose-lose scenario. But 19, so back under 20% bullish here, and 48% bearish, 32% neutral. So a lot of neutral, but a lot more bearish and a lot more bullish than most we've seen in a while. A lot less bullish, most we've seen in a while on the bearish side, which I was thinking to myself, like, okay, like, what do we think? Like, can we build, can we kind of like back our way into a thesis off of this? Like, is sentiment going to help? And to be honest, like, I could see a scenario, market kind of comes in, builds a higher low here. If that's the case, why not go back and maybe make a higher high, over 420, somewhere up into here, right? Why not, right? We can do that. Maybe not that fast. Who knows how long it takes, but why not? I can see that scenario in the near term. I think another thesis is that when the Fed finally cuts and pivots, we get a problem. I don't think a pause would necessarily get us there. Let's see. And the reason why is because, okay, the Fed's going to finally cut or finally pivot or pause when there's a problem, right? So if you go to the next meeting, which is out to May 3rd, so we got it's about a month and a half until the next meeting. Next meeting, we're looking at about a 50-50 shot of a pause versus a 25 basis point hike is the look. So we'll see. That's kind of the first early looks at that next meeting as of right now. So I'm surprised there's not a higher percent chance of a pause, but I would imagine that's going to change substantially in the coming days and weeks, right? Going into that next meeting. So that was cool to at least mention the sentiment stuff, but let's see if I can pull up what's more historical sentiment data. Tell me. Oh, cool. Yeah, this is good. This is what I wanted to see. So if you go back in time, I've been looking at this a lot over the past like year. If you go back in time, so the top is 2023, and then it goes back into 2022 here. This is the lowest. Really, I remember seeing some 19s. It must have been back in September, October of last year. So it must have been a while back. I remember seeing some under 20s. This is the first time the bullish reading has gone under 20% since the fall of last year. Bearish is at 48. Is that the highest that we have seen? No, we saw a 52 bearish in December. Makes sense. And it was actually just on the cusp of 20% bullish. But the second highest bearish reading and the lowest bullish reading that we've seen since the fall of last year. That seems pretty impressive to me. And not to mention, right, when this report, the week that it ended, right, essentially it was just kind of, let's see. Yeah, it was catching this, right? It was catching this move down, right? That's what we're kind of people freaking out about. So it was a relative low, and it makes sense. A lot of these really bad sentiment readings come in near relative lows. I mean, we had this mid-October timeframe, September-October timeframe. That was a relative low. And if we go back to that sentiment survey, like that's when we were seeing some, if you were to go back in time even further, let's see if I can download this. This might be like a nasty document, so I have no idea what we're about to uncover here, but I'm trying to pull it up and see if I can go deeper into time. Opening. Oh, here we go. Here we go. Can I even... Oh my gosh, it goes back to 87. All right, so if I scroll all the way down, I'm sure we can find it. And maybe not. Chart. Let's see. This goes back to 2022. This is the stock market on the top, S&P, and then percent bullish. So yeah, I mean, you had some low numbers. If we can pull this up bigger, you know, if I was to adjust this like a tiny bit, if I can, and no, it's being weird. Zoom it to 100%. Okay, cool. Yeah. So if you, these levels right down here were like 10% is the bottom. So you had your lowest. There's some peaks down to the downside here in early 2022, and then some lows in late. So yeah, I mean, we had a reading essentially coming in line with some of these lows. And the thing that's kind of crazy to me though is if you look at that, you know, you don't really have a stock market that's like threatening lows. Like you have a relative low being put in, yeah, sure, but it wasn't like we're down here, you know, which is kind of interesting. So I don't know. Sentiment's pretty nasty, man. We've seen some pretty big bounce backs off of, you know, when sentiment gets this bearish. So I don't see why, especially given that this is technically a higher low. If that holds, if this level holds, if 380 on SPY holds, like why would we not, you know, potentially suspect, you know, a higher high? Who knows how big, but potentially a higher high until this trend line, until this, you know, this structure breaks. That's kind of the look on the S&P. Whether you like it or not, it doesn't matter. Who the fuck cares about, you know, oh my God, the crisis. Who gives a fuck? The market doesn't give a shit. The market's going to do whatever it wants to do. You know, it doesn't matter what you think. The market's going to do what it wants to do. So it technically doesn't look terrible. 10 minutes until Powell. Either way, either isn't really good. If they pause, be signal something's wrong. Yeah, that's like your lose, right? Pause. You pull a pause here and like, well, so that they kind of maybe are going to go, thesis or an idea is like they kind of have this, not illusion, they're going to go with this like idea of like everything's fine, like we're good, we'll do a 25, and then maybe we'll just you go back a month and everyone was expecting a 50 basis point hike on this meeting, or we're getting, you know, something like that, or go back 3 weeks, right? And that's the deal. And we were thinking, okay, rates higher for longer. And now I think it's pretty much like this idea, like maybe not that high. And we had these back and forths. And I think you can look at the 10-year yield. The bond market is a perfect example of this happening in real time. You know, go to the past, like, you know, go to a 2-hour chart. Early this year into early February, yields were down here, and that's when we're thinking, oh, inflation's going to be good. Like, we're going to be done. Like, you know, Fed's going to be cutting rates sooner. We're going to pause sooner rather than later. Then that was maybe made apparent, oh, we had some higher than expected numbers, or just kind of the job market staying pretty strong. And then we kind of start seeing yields go up. Oh, higher for longer. And then we have the bank situations. Oh, shit, maybe we got to cut rates soon. Maybe the Fed can't hike more, or else we're going to have more problems. And so you kind of have these extremes, and like we're kind of finding a balance, I think. To some degree now. Overall, natural gas retesting lows. Yeah, that's gotten crushed. Oil has been getting crushed. Yeah. Here's nat gas. Here's the yearly on. Yeah, it's down. It doesn't look good. It broke down below this 2.4. It does not look good at all. I have been bent over 17 times on nat gas, so I'm going to just leave it alone. But yeah, it does not look good. Oil back over $70 on oil. So it broke down below the lows of December. And then it got back. It's trying to claw back up. I just still don't think, like, yes, you had a big move down. Fair, like, great. I just don't see this. It could easily do this, right? And if it does this, fine. I would want to see it be more constructive in terms of doing that, right? Like kind of make some higher lows and get up there. But until it gets above 83 with some strength, you know, it just looks horrible. Like oil looks horrible. I mean, I can see it sub $60 at some point here. We'll see. It's going to be it'll be pretty impressive, let's be honest, if you break down below this level. But that's like the next spot to watch. It's like 60, 62, 61, 62. And then if that level breaks, 50s coming, you'd think. Kicking the can down the road. Action. Yeah, it's kind of, I think that's, if the Fed, let's say that the Fed really wanted to pause, maybe, or there's a lot of concerns that they're not letting people know just yet, and there's bigger concerns that they're discovering or whatever, and they're like worried about stuff. A pause, almost like right now, would kind of signal to us, right? Like, oh shit, like, you know, that's something's wrong, right? They kind of want to like ease us back in, like, it's okay, we're gonna be fine. And at 25, you know, how bad of damage is a 25 basis point rate hike gonna really do in the grand scheme of this hiking cycle? Is it a big deal? Probably not. If they got to pause next month and they can kind of pause and let things kind of ride for a few months and see how we react, see how the market does, and see how the inflation kind of comes down, see how the job market does. Yeah, it would be a good spot, or a good, you know, I guess, way to kind of test it out and feel things out, right? Without causing a ton of panic, you would think. So about 7 minutes until Powell comes on. We got his press conference here in a bit. We'll have that. We'll have his live talk and reaction. If I can go over to YouTube. Pulls up on YouTube. Is that possible? Cool. That's sick. That's what we're going to do then. Okay, so we'll do that. Pull that up over on the tube. And then we'll see what happens. Once Mr. Jerome hops on. Audio was good before. We'll double check. I can adjust as he comes on, you know, if we need to. But in order to minimize the echoing and whatever, I'll mute myself, and I can jump back in. I can unmute myself if I want to, whatever. I'll essentially mute myself. We'll have Powell, and I'll see if I can pull up Spy or something, you know, on the same screen. You know, just kind of put two tabs up and have them both go. Because I think that the honest reality is going to be, you know, the questions that we get, and I hope that they're not softballs. I really hope that they're not. I hope that we get some good insight, you know, and we can kind of see, you know, where we're at. As of right now, Fed futures traders are looking at a 62% chance of a 25 basis point hike in May. So for the pause idea, it's kind of funny how now we're looking out to May, a month and a half from now, and we're looking at a potential. Traders are pricing in a better than a 50-50 odd, better than a 50-50 toss-up, that we're going to see a 25 basis point hike. Interesting. Whole banking crisis got calmed down. And I think you look around and like tech stocks are doing well. It depends on the sectors. Like, you know, the financial sector got crushed. You know, let's look at some of those ETFs. By the way, I like, if today is good, this week, it's today. If this week is good and we end up closing this week on XLP, Consumer Staples ETF, above this trend line, I will potentially add a little swinger on that guy. Maybe some 75 calls, which are up here out to, like, you know, a month or two. It could be others for like a little downtrend break, pop it up to 75, you know, and then take profits if it, you know, on the way up into this move. If we end up breaking back down underneath like 71.70, stop out. So do the risk reward profile on it. And let's see. What are we going to get? Risk reward of 75. Just north of 75 would be a perfect 2-to-1. It's a 1.93 to 1. It's like a pretty much 2-to-1. So, and I think that this is the idea. It is to fill this lower volume kind of gap area up into, really honestly, 76 is an idea on that. So 75, 76 could be like a nice target zone to look at for a take profit on this thing. For a trade, just a trade, not an investment. You could invest in it too, but just a trade idea. From a chart perspective, XLP from a nice little downtrend break. It looks good. I like it. I like that idea. For a little swing. Well, it's 50-day moving average. Yeah, let me pull that up. I haven't pulled those eyes for whatever reason. It's just at the 50 moving average on XLP. So, and it's been a choppy name. I mean, or a choppy sector, right? You know, it's popped to 80 plus, fell down to 66, back up to 77, back down. Yeah, higher or low though. So look, that's a nice downtrend break though. If that actually ends up breaking, if you go to the weekly, let's see what the weekly looks like. Zoom this in on the weekly. if this ends up breaking nice, like ideally it's a more of a weekly chart type of break. If we close up here, great. That's a swing idea, on the weekly. So today, could you get a scenario where today, it truly starts to go, yeah, but we've seen it many times where fake out, right? The first day after the Fed is the fake out, and then you get the massive move after where it's like the opposite of what you thought. Just be careful, and just knowing that, and knowing the environment we're in, right? No need to be like, oh, I'm going all in, who cares? No, this is a worthy idea from a chart perspective. If the market cooperates and whatnot, and great. But if not, then who cares? There's going to be plenty of other opportunities out there, right? Up and down. I was looking for XLP for the 3X ETF. I didn't see one. I couldn't find one this morning. But in that scenario, maybe it's an in the money option idea or a slightly add the money option idea or something like that. I think is the general gist for this. It's funny how on the dip too, it got loaded up. Like look at the volume here on this move. It held a nice little higher low relative to the October lows. And of course, it's a while ago, but a lot of volume came in on here. Now, of course, a lot of volume came in the overall market in general. If you go to SPY, you'll see it generally the same thing, right? So someone was buying it, and buyers, I guess, of the past two weeks or so are feeling good now. Will that be the case by the end of this week? We shall see. So Powell's coming on in 2 minutes. 2 minutes until Powell. I can get rid of this audio test, and then we'll have him right over here. But yeah, I just got back from Utah yesterday. We got a souvenir. We got a little souvenir. I think I just sprained it, but unfortunately, but it's all good. We got a POW day at the end of it all, so I'll take that. The board behind me is I think it's officially being retired this year. I've had that board for like almost 10 years, I think. So I think I'm going to get a new one. Hopefully spring, summer deal. We could pick something up for next year. But it was good. I had 2 nice trips, skied a lot, snowboarded a lot. And yeah, excited for next year. If we get the same weather, I mean, oh my goodness, it'd be awesome. Used to be need, I guess it's not. It's a bot trading anymore. Not trading anymore, unfortunately. Sprained my wrist many times. So what's funny? I've only sprained my wrist. I think I fractured it one time snowboarding back on a trip in was it middle school? Oh, here he is. Let me pull this up. We'll talk about that later. When he comes out, confirm the audio. Make sure it's good. If it is, great. If it's not, let me know so we can adjust. And I'll see if I can, give me like a minute to rearrange. I guess I can do that now. Let's pull this up and let's see if I can get Mr. Jerome popped up nicely. Yeah, I can pop him right here. Is that going to work? No. There he is. There he is.
Good afternoon.
Let me know how the audio sounds.
Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters,
not
as
a
well
big
as
range. I
measures
mean,
from
ranging from
financial
40150 down. Now we're getting hit a little bit.
The Fed's monetary policy
397,
actions are guided by our mandate to promote maximum
down
employment
toward low of the day
and
now.
stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.25 percentage point bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell
A
inflation.
huge lower wick there on
Instead,
SPY,
we now
back up to
anticipate that
near
some additional policy firming may
399.
be appropriate.
Let me just change these candles.
We will closely monitor incoming
Give me a
data and
sec.
carefully assess the
not
actual and
hollow out. It's a
expected
little easier
effects
to
of
see, I
tighter
think,
credit
when you go
conditions on
regular
economic
candles.
activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation.
That's a nasty wick now. Yeah, that really
We
is.
remain committed to bringing inflation back,
Right back
down
up
to our
into this
2% goal and to
consolidation
keep longer-term
kind of crap
inflation
we've been in for the
expectations
past,
well
really
anchored.
since the
Reducing
initial release.
inflation is
Hopefully
likely
the,
to require a period of
questions he gets
below-trend growth
move
and some
us.
softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
The good part.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SEP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses and thereby weigh on demand.
I feel like he's
on the
reading off
labor
a script
market
right now
and
after
on
a question.
inflation.
Kind of weird.
Such a tightening in financial conditions
He's,
would
like, clearly
work in
reading
the
the
same
script.
direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes maybe, some policy firming may be appropriate.
Oh,
So
there it is.
going forward,
Change our
as I
guidance
mentioned,
from
in
ongoing
assessing the
hikes
need
to
for further
some
hikes, will be focused as always on
additional
the
hikes.
incoming
Possible?
data and the
It seems
evolving
like they're
outlook,
setting up the
and
pause
in particular
at some
on our
point.
assessment
Whether
of
it's
the
May,
actual
whether
and
it's the next
expected
meeting,
effects of
I don't
credit
know.
tightening.
It seems like it's coming soon. Markets back up towards highs.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So,
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
no, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Approaching
Nick
high of the
Timmeros, Wall
day.
Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting, but I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk
Market just hit a
exception
new high today, 402
to allow
on SPY
uninsured
and
depositors
climbing.
to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. You know, I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week, so, but that will be up to him. So that's really where it is. You know, the review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that, you know, there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, you know, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, you know, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from, tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we've well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
And one other question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Thank you, Mr. Chairman. Edward Lawrence from
Shorts
Fox
and longs,
Business.
both getting trapped
Inflation
now,
has
right?
been
Big
rather
wick down
sticky.
earlier.
So do you need help from the
Down
fiscal
here.
side to get inflation down
Big
faster?
push up, 402.50.
We don't assume
Now we're
that.
back at 400.
We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I could follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
You know, if you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps, part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you. Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
No, absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation.
Some of these questions,
and
man,
we're
it's like,
going to be watching to see what that is, and we'll
like
also be
common
watching
sense.
what's happening with inflation
Yeah.
and in the
No,
labor
it's
market.
just Drop
So
City.
We'll be watching all those things, and of
Powell
course we
makes
will
happy.
we will
I mean,
eventually get to tight enough policy
This is kind
to
of
bring
like a
inflation down
meh
to 2%.
type of reaction,
we'll
to be
find
honest.
ourselves at
What
that
it probably does is it kills premiums of options like crazy.
Hi, Chair Powell. Thanks for
Right.
taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed,
from new high,
are you promising to bail out all of its depositors?
Talk about a nice little swing. That's a good volatility.
I'm not saying anything more than I'm saying.
$5 or so.
What I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that. If the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
Yes, sir.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer.
So you
today.
don't have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, this review's going on, and I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were
okay.
to tighten enough, if that would prompt a rate cut.
So, financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it, and then once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and so that's all I have to say. So, thank you very much.
Boom. That is it. Rate cuts are not in our base case, is how he cuts it off. So we can get rid of that, and now we can just watch. So essentially, what went down was Fed raised rates by 25 basis points. Okay. Market initially reacts in a positive manner, as this little pop right here. And then we kind of consolidate, right? Not surprised going into Powell. Then Powell comes out, starts talking. We have this big dip, gets bought up, make a new high of the day. Then the past half hour, we just kind of sold off and made a new low of the day. Now we're bouncing up off the lows. So essentially right now we are bouncing. And where do we bounce? Look at how perfect this kind of lined up. Look at this. Right off of yesterday's lows. Pretty impressive how close it was. Yesterday's lows around this like 395.60, and today's lows around 395.67, so like within 10 cents, or something like that. So he's done talking. The thing that I take away from that whole thing is essentially people asking about rates and all that stuff. He believes, and they believe that with some of the bank stuff that's been going on, we're getting to a point where there are going to be risks elevated, and these credit risks and these other tightening of credit conditions and whatnot will help bring down, or will almost do the job of additional hikes that maybe they thought a month ago that they were going to have to do, get up towards 6%. Maybe they can kind of chill in the low fives. Maybe where we're at right now is the peak. Something like that. But because of what's going on, because of what they've already done, there will be more things that will help kind of weigh down an inflation problem. But then again, if not, who cares? We'll just come back in and hike in the future, or we'll keep hiking if we have to. So that nothing insane that like I would be like, oh my gosh, holy shit, we're fucked. Like there's nothing like really. Let's be honest. Calm down, right? There's a lot of problems. There's a lot of problems, a lot of concerns. But at the end of the day, Powell's not going to come out here and say that, right? His job is to kind of keep everyone calm almost in a sense and restore price stability is his whole thing, right? So the Fed's whole deal. So that's kind of my takeaway from it all. In terms of the market reaction, right? It was positive, then negative, and now maybe we end up a little red. We'll see what happens. We're bouncing off of yesterday's lows. That's a spot to watch. We came up over 400, back down 395. So we're bouncing around in a $7 range or something like that, which is pretty good. It's a good amount of range, right? In terms of what else is moving, the 10-year I won't say plummeted. It didn't plummet, but the 10-year fell off a bit ever since the hike announcement. And then while Powell was talking down towards 3.46, now it's at 3.5% off. If you look at the 10-year on like a 1-hour chart, you get a better view of it. Maybe it's setting up to give us like a little inverse head and shoulders, maybe. But, you really don't want to see this thing dropping much down below like 3.4 for that to kind of stand. So you just want to kind of see it fall into this white zone and then bounce back up if you are looking for an inverse head and shoulders. But remains to be seen if that's the case. My stance on it is pretty simple. My view is, what's the best way to kind of hedge yourself for a bad recession? And it's bonds. It's TLT. It's positioning yourself in something like this. And TLT, we look at TLT. Here's the 1-hour chart. Clearly needs to get above 109, 110. Right now, it's kind of in this consolidation phase after the whole banking situation, and yields just plummeted, and TLT and bonds went up. People are flooding into bonds, flight to safety trade. I still envision that that's the case, especially if we have more bad news and all those things. It's a great way to hedge it, in my view. Hey, in the perfect world, right? Maybe we just consolidate for a while and, not much happens, and maybe the market and the economy's fine. And is that necessarily what a lot of us believe? Maybe not, right? And just to kind of hedge that's why I think a bond play is not a bad idea. And I think this recent mess with the banking situation, I think it's almost solidifying, but I think it really removes a lot of downside risk in the bond plays, right? In a TLT, right? Because now you can just see the concerns that we have, number one, and then that removes a lot of the downside risk of, okay, in the short, like we were talking about, in the short term, it's very possible that maybe yields, like we were looking back, a few weeks ago, we're back up in here on bond yields, and the 10-year was back over 4%. We're like, well, it's possible in the short term that yields maybe push up, towards 5, or who knows, somewhere up into the mid to upper 4s. In the short term, because, inflation staying higher for longer talk, all that stuff, right? But I think that this recent developments, I think that's like your risk here, at least in the next, 6, 12, 18 months, maybe longer. Who knows? Do you want to start predicting out 17 years in the future? I don't fucking know. Who knows what's going to happen, right? So who cares? It doesn't matter, right? But I think that your downside risk on bonds and your upside risk on yields is kind of capped somewhere up in here. Do we even get up there? Who knows? I think that's kind of your risk level, right? So it makes that trade a little more, I think, easy to visualize in my view, or that positioning. DXY, the dollar just took a dump and a half during that since the rate hike and during the press conference. Came down to pretty much 102, and now it's back to 102.35. So it's bouncing around. What that's going to do is that's going to put some upward pressure on gold, silver. Look at silver, just broke out of this little bull flag to the upside here. Silver, by the way, it's $2 away from breaking out of this range, right? Or breaking out of the recent resistance, which is up here around 24.50. So $2 from here on silver, boom, you're popping through. You're almost at 23. $2 from here puts you near 25, which would be, up in here. So you're getting closer and closer on that. That's the key spot to watch. However, gold, on the other hand, gold looks really good. Gold is, it's testing up to the past 3-year high, like right here. So I'll draw these levels in on gold. We got this level right here. Honestly, it's like a double top. So you got to test, 2075 on gold. A 2075 test, 2075, man, on gold would be really crazy. It's about $100 from here. So not a big move on gold, considering how it looks. That would be a big move. Let's go to the weekly on it. Honestly, even the monthly chart might make sense to look at too here. Look at this. Here's the monthly chart for gold. This goes back, decades. if you kind of zoom it out far enough. But if you zoom in, I mean, this looks pretty good. I mean, to me, right? In terms of, from a monthly perspective, if you break this level, you know, you would think we're going to get a nice push right here from a breakout perspective. So I like that look a lot on gold, especially if it can pressure that level and stay strong from now. You know, you don't want to see it ideally dropping below 1800. You want to see those levels hold. The past 2 or 3 months, that's been around where the low's at, around 18, just north of 1800. So back to the weekly chart on it, right? You can kind of see this level right here. If you go to the weekly, you know, was our bottom that we bottomed out in 2020 last fall. But, you know, you want to see this level hold right here. Ideally, this higher low we just built, you know, a few weeks ago. That holds, we're looking good, right? Because then that's putting more pressure towards the highs. And the more pressure towards the highs, the better chances of eventual breakout we're going to get. If you're bullish on gold, I think that's not a bad spot to be. You know, gold, silver, with the dollar weakening, I think bonds are not a bad spot to be, right? Anything can happen that could change this idea. That could screw that can toss those trades out the window or those investments out the window. But from like the way I look at it is kind of more of like a swing, a macro swing, you know. And do I really care about the timing of when it happens or whatever? No, but if they look strong, right, fine, you know. There's no reason to jump ship on some of those positions. So that's kind of the look, you know. Airplane, but it's their economy. Good on bonds, 2025 TMF contracts, good enough. Yeah, that's solid. TMF been shopping around. I've been selling the covered calls, so it's been kind of minimizing this chop that we've been kind of dealing with. But same kind of general deal with TLT. Although, right, the decay, you can kind of note the decay here with more of a clear downtrend. Whereas if you look at this is the 3X TMF, where if you look at TLT, it's not as nice. The downtrend isn't as steep, and it's actually more of almost a horizontal level than it's a slight downtrend, but it's more of a horizontal. So that's kind of showing you the decay, right, factor in the TMF, right? But more of a downtrending resistance versus more of a horizontal in TLT. So that's our looks there. Outside of that, SMH Beast from Bray. I mean, I don't know if you guys have ever watched the stupid show. What's it called? I forget what it's called. It was some stupid show on Netflix a long, long time ago. And it was like, there was these stupid, it was lost tapes. And it was like these kind of, these jokes. It was almost jokes, but they were just like hilarious. And my brothers and I would always watch that stuff all the time. I don't know why Beast from Bray wrote. It's like one of the lost tape kind of episodes. And it's just like some random, like, unknown beast that would just like kill you. But that's that aside. This has been strong. It's been strong. So I'm looking up here towards like 265 on SMH, which really isn't that far away. We're up in this volume node. Would expect some more resistance there. So 265 will be the spot to watch. And that's where I think, if we do the math, SOXL is the 3X ETF on SMH. You can see it's not at the highs, even though SMH has hit a high because of the pullback. It's not at the highs right now compared to February 1st. So I'm thinking this could push to $19-20, you know? And then I have a covered call for this week that expires this Friday on, let's go on to the Robinhood portfolio. Let's jump over here. Yeah, you can see that, right? So yeah, I have a cover call. It's up here that expires on Friday. Yeah, Friday, 2 days at 19. So if it hits 19 by Friday, it's at 1745. It could get there. If it does, then I'll get taken out on 100 shares and I'll have 40 shares left. I had 140 shares, or I have 140 shares of it. But the look at this portfolio though. To be honest, I'm pretty happy with it. Like, I haven't done much at all in here outside of selling covered calls. I have my hedges. So where's my put hedges in oil? I have hedges on oil. So if the market goes down, of course, oil could go up, which would kind of fuck me there. But we'll see. Generally speaking, that would put pressure on stocks in general. And I think the gap between oil stocks and oil, like crude oil, is pretty substantial. That any pressure in the market will probably put some heavier weight on those stocks. So we'll see. I'm up nicely on, I think I'm flat on the Oxy put debit spread. which is more of a time play, if anything. And I'm up like 30% on the MRO. Was up like 75% at one point, but then oil bounced back a little bit. Not surprised. But it's been doing good. What's been helping us out? Here's the past week. I haven't touched this at all until today. And I only did one thing today, which I'll show you in a second. It's up 6%. Or actually, no, past week it's up 8.5%. I was skiing. I was snowboarding. I didn't do anything. I was up $700. But, really, it's because of the positioning I have, right? I got positioning in a nice dividend play. If I get myself out the way here for a second, look at this. Oh, not that. This one. Nice dividend play, JEPI, right? It's paying me a nice dividend. I'm buying $50 a month on that automatically, just putting in just to kind of make sure. And plus, I'm getting the dividends reinvested back in. So we're building a nice cash flow machine over time. And if I felt like I don't freaking know what I want to do, and let's say Soxel goes to the spots I want, I get taken out there, and AGQ I sell, and Tesla, the TSLL I sell. If I sell all that shit and I'm like, I got extra cash to put in, maybe I'll add more into that. But for now, I'm just going to slowly adding into it as I feel or as I have, funds, or just letting the dividends reinvest. And that's that. So we got that in there. We got a little silver exposure, right? And we got a little Tesla, TSLL, a little Tesla exposure. I'm up so much on it. That's why I'm still holding it. If it falls back under 10, I'd consider cutting it. But I'm up so much that it's like, I may as well just sell covered calls on it and run this thing out until until we feel like we're getting back into greed, and we're not there, right? Sentiment survey wise, we go back to the home page here. And what do we got? Actually, that's not what I want to do. I want to go back to the this. If we start seeing a 30+% in bullish territory, okay, we're getting greedy, and if Tesla's ripping to new highs on the year, okay, I'll take it off, right? That's kind of the way I'm looking at it. Let my covered call get hit. It's kind of the way that I'm looking at it, right? On that. So there's a couple things I could do to add in, but I'm kind of just chilling with what I have now. I think it's a good spot, and ideally, the way I would feel comfortable of going in heavier on shorts or heavier on hedges, I'd want to see us rip up. I want to see the market get back up into the 400s, spy up into the 400s again nicely. And then if we're up there and we're chilling up there for a bit and people are like, oh, bull market is, going to the moon, and we start rallying really nicely, okay, then I would be maybe more comfortable in going heavier in hedges and trimming out them long. So just kind of just being going with the flow, right? In a sense on this portfolio, and trying to kind of slow, not jump into too many option stuff, a little bit of here and there, but mostly selling options, some hedges and options. And that's kind of the way I'm going with it. The one thing I did just do is XLP. I bought today one starter position for May 19th expiration. The reason why is, let's go back to the charts here. It's breaking the downtrend. I will add this one if we get confirmation this week. I will add a little bit more into this position. So it's actually, I only have one. I'm going to buy one more right now. It's either going to stop me out like very, very soon, or it's going to be, let's go 0.91. Buy to open 0.91. Oh, put the order in. I'll double this down, to get 4 or 5 contracts of it. Put it myself, $400 or $500 in, and looking for like a 50+% trade. That's really it, just because we're breaking the downtrend on it. But outside of that, that's the only thing I did this week outside of selling. Actually, I didn't sell any covered calls this week because I just got home. I could, but let's see. If we rally up a little bit, we'll see. Then we get better option prices anyway. Maybe AGQ. AGQ could be good because we're having a nice rally the past month on silver. Past couple weeks. Let's look at AGQ and see if we can sell a covered call here. So AGQ is a leveraged silver ETF. Sell a call out. Let's go. Let's see. Yeah, we got to go out to April 21st. 30 days, about a month away. So can we get paid a decent chunk of change? This thing, let's go look at AGQ's price history though really quick. This is pretty cool. I can pop that down. Over the past 3 months, right, the highs were up around 32, 33, and now we're sitting at 28. Could we go to a new high? Yeah, sure. So, but just knowing that over the past 3 months, the general range can kind of back me into okay, we're gonna look to sell. Maybe the 35 strike, maybe 36. They're honestly not bad. 37, I get paid $25. I'm gonna take that 37. That puts me way out there. Let's see if I can get filled at 30 cents on this. Let's see. Medium fill likelihood. per Robinhood. There it got filled. So I got paid $30 there to essentially sell my AGQ shares next month, a month from now, at $37, which would be about almost $1,000 on the actual position. The position would have to go up about $1,000, which is like 10% on the portfolio in a month. And I also got paid $30. That's pretty good. I'm going to take that. To be honest, when it comes to stuff like that, there really isn't a ton of math, in my view, that goes into some of that stuff. It's just like I'm kind of looking at the range. Could we have an outlier move and could it go crazy? Yes, it totally could. If that's the case, I could just let it take me out and just take my profits on it, because my average on AGQ is at 23.39. So that would be, I'd be up, 50+% on it, right? So I'd be up looking nice, like around maybe like 50-ish%. I think. I don't know. Something like that. I can't do math like that off the top of my head. And, great. Or I can always roll it, right? Come the time. So maybe that's an idea. We'll see if we get there. Cover call ETFs TSLY and OARK. Okay, those are nice. Like those are some, I think it's becoming more popular, right? The covered call approach. And you can do it yourself, right? Or you can essentially just go into a fund that does it for you. And so it's like, it's kind of cool. Let's check it out. TSLY. Let's go to TradingView and just look at it. Tesla Option Income Strategy ETF. It's pretty cool. Pretty cool. So dividend yield doesn't have it. It said last payment was on March, or the ex-dividend date was March 7th. So I'm assuming this last payment of 90 cents on this accounts for that. Interesting though. Let's look at the TSLY ETF. Let's pull her up. ETF.com. Is that going to give us good stuff? It's fairly new, right? So there's not too much volume. The volume is only getting more entry now. Pretty cool. Capped gains and current income on Tesla stock. Covered call strategy through a synthetic covered strategy. Okay, cool. Expense ratio of around 1%. So keep that in mind if looking at it. Total return chart. It's kind of cool to look at that. If you were to have invested back on November 23rd, you're just down a bit. Obviously, Tesla's been through some volatile times since then, right? That's kind of cool. I like how they're doing that though. That's really cool for some of these stocks, because it's a really, it's like people, you could do it yourself, but also what if you don't have enough money to buy 100 shares of Tesla, of Apple, whatever. So now you can get access to these things, or you want to diversify into like 6 of them. Maybe you have enough to buy to 10, maybe 10 of them. Maybe you have enough to buy 100 shares of Apple, right? And Tesla, but not Apple, Tesla, Nvidia, Microsoft, Amazon, like all Google, all these names you want to have exposure to, for example, right? Meta, throw that. Maybe you want to have exposure to all those, but you don't have, the funds to do 100 shares of each. So then you can do this. It's pretty cool. Let's check out OARK. Let me go back to that same site, ETF.com. So they're going to essentially do the same thing with ARK, or ARK's ETFs. Pretty cool. So what is their let's see. $11 dividend. They pay monthly. That's sick. That's what's sick about that. That's what I think it's the coolest part about it, is that they pay monthly. So the thing is, like, when people like look at this stuff, like, I don't know, maybe I'll just do it myself if you have the funds. Well, fair, but they do this monthly. And so you could just have a simple reinvest the dividend strategy where you literally just let this operate. You're not selling covered calls. Someone else is doing it for you. You're getting exposure to ARK. You're getting exposure to Tesla. You have a little bit of downside protection, not too much, but you have a little bit of downside protection with those covered calls. And then you have monthly cash flow coming in. These are fairly new, right? So it would be nice to know or see how they, were to play out over time versus like an ARK and stuff, and going back through, because they're actively managed, so it's kind of interesting, but it's pretty cool. 100% portfolio exposure to a single stock covered call ETFs. Yeah, that's sick. I like that idea. I like that. I think that's, especially from a cash flow perspective, from someone who like looks at things from that perspective, like, come on, like you can't beat some of that. When it comes to compounding portfolios, compounding your, investments and over time. Obviously, how do you kill it the most? You come in, you go, fuck it, I'm going to go all in Tesla. And you go, hey, I'm heavy Tesla. And you nail Tesla back in 2016 and you freaking kill it, right? And you don't have your upside capped as much and whatever. And you just nail it with shares. Like, yes. But what about the downside exposure? What about your mental? Like, there's a lot more to consider, but when it comes to like looking at stuff like that, especially during volatile times. Like, what if we go through a 10-year chop and we don't freaking move for 10 years? What happens? Well, you're going to be sitting there, and you're holding your Tesla shares that pay you no dividend when maybe you could be collecting a dividend off of the covered call strategy, right? And at least at the end of those 10 years. Instead of having 100 shares, maybe you buy, a share, let's say you buy 5 shares a year, okay, cool. You got 150 shares if you were just to buy 5 shares a year, right? For 10 years, and you kind of just like dollar cost average into like a Tesla, or just, you can even just be SPY, all right? Same thing, same concept. Now you're going to have 150 or 175 shares, whatever the number is, because the dividend's getting, or the covered call strategy, the monthly dividend getting reinvested into buying more shares, fractional shares of the stock, like boom, So now in 10 years, you're sitting there like, oh, I had 150 shares. Well, maybe with this strategy you have 175, and you essentially did the same exact thing, just bought the same amount. But because the dividends are reinvested and you kind of kept compounding, and then maybe Tesla goes on a 2-year massive run, like it almost did the past couple of years, massive run, and it 3Xs in 10 years. I don't know, just an example. Boom, now you've got that many more shares. You're going to be, that much better at the end of it all, right? 25 TSLYs. Sick. No sweat, high yield, kick your feet up. That's and that just kind of brings it back to like, to be honest, like why I view like, people with like real estate, and there are a way you could do very, very well when it comes to all these different aspects. And there's a lot of things you can do, but there's nothing, in my view, there's really just nothing like the stock market in terms of the potential opportunities, the endless opportunities. And then you find new stuff all the time like that. Like you're going to find, these dividend ETFs or these like covered call ETFs on, your individual stocks or on, sectors and whatever. And it's like, that's sick. Like I can now, maybe I don't want to reinvest the dividends, but maybe I had $25,000 that I was like, I could put this on I could go buy a property and, maybe get myself into that. And that could be a whole thing, rent it out to a tenant and have a whole thing. Could be cool. Maybe I want to do that. Or I could say, what? Maybe I can get rid of all those headaches and just take the $25K, put it into this fund, get paid a monthly dividend of whatever the number is. Now I cash flow $150 a month. I'm just making that number. Maybe I cash flow $200 a month. I don't know. Whatever it is. And now I don't reinvest it. I use that to pay for my, electricity. Like I don't fucking, and then boom, there you go. And just like you would have used the rent from an apartment or rent from a house that you're renting out to pay for the down payment, now you can pay that for your rent or pay your utilities, or you can just compound it and just keep building up a bigger and bigger cash flow, right? It's just the whole game. There's so many ways, so many creative things you can do. It's honestly sick. It's like, it's awesome. I think it's like the best place to be. And there's just endless opportunities. Really, that's really what it is. So trying to work my technical analysis a ton on SPY so I can time my 0-day contracts better for sharp quick moves. Let's check back in on SPY. We kind of jumped away for a bit. We're down 0.45. The NASDAQ is kind of green, but it's coming down to flat. So yeah, we got a push back up towards VWAP, and then we kind of came back down. We're trying to build a higher low, maybe on that. The reason 100,000 for 5% on real estate and deal with it. Nah, I mean, that's the thing. I mean, for the diversification approach, like I can see that, right? But I mean, it's tough, especially with some of these different things. It's tough. Like if you had an extra, I don't care what the number is, to invest, you know, it's like, man, there's so many ways to play that into the stock market. Obviously, there's always risk, right? Just like, but the thing is, there's risk in real estate too, you know? There's risk there. And what happens if, you know, your tenants destroy the house? What happens if this and this and this goes and you got to replace all these things? You know, it's like it's a lot more. The way I kind of view real estate is this. At some point in the future, if I wanted to get a place for myself, right? My brothers and I we think of the same way. We're like, let's just go in, split up a condo or a house, a ski house or whatever, right? Split it up, go in, we can afford the monthly payments. Great. We buy it when the time comes. We want to buy it, we buy it. And we have a place that we can always go whenever we want, right? And great. And if we can rent it out, maybe it's easy enough and we want to do it. Sure, if it pays a few bucks, are we doing it for the purpose of trying to cash flow and try to, you know, do? Not necessarily. We're doing it for the purpose of like having a spot that we can always go to at any time. But the idea of if we can pay some of the bills, right? Cool, we'll do that. You know, when we're not using it, or maybe rent it out on the holidays because maybe we don't want to ski during the holidays. Let me tell you, skiing during the holidays sucks. It's crowds. I don't want to be there during the holidays. Yeah, it's cool, and in theory, it's like, oh, you know, my mom always says, I'd love to rent out a cabin, you know, in the holidays and stuff and go skiing. It's cool. It sounds great. You know, maybe for you and then the nice, you know, family together. Cool. But the actual skiing, if you actually like skiing, it kind of, you know, defeats the purpose because like now you're there with a million other people. And so, you know, okay, so rent it out when you can get the highest premium and you don't want to be there anyway. Make your change, make a few bucks, and then you have a place. And maybe in 20 years, if you want to sell it, maybe your investment pays off. Like that's kind of how I view like some of the real estate aspects, real estate side of things. I'm not very interested in getting into that now. There's a lot of other tax benefits. There's a lot of other benefits, sure. But to be honest, with the stock market, there's just so much. There's so many things you can do to be creative. There's the Roth IRA approach for tax benefit purposes. There's a whole bunch of stuff that you can do. Different strategies. You can make money in uptrends, downtrends, bear markets, but it doesn't matter. There's so many things you can do. And who cares if sometimes about like we talk about, who cares about what the market's going to do? What if you're like, well, I can predict the Fed and the bond market in the next 6 to 12, 18, 3 years, whatever the hell it is. Let me just put my money in bonds, or, you know, I can trade off of the volatility in bonds and I can just play that. Like there's so many things. I can trade off the volatility in the dollar and, you know, and metals, or who knows? Like there's so many things. Oil, there's so many things you can do. And as long as you're educated and you have a way to manage risk and a strategy, right? It's endless opportunities. Buy REITs for real estate. Exactly. You could just buy REITs. True. VNQ if you want everything. Put it all on SPY. Got all dividend on SPY yesterday. Makes you want to play even more. And then when you start getting paid the dividends on these things, you're like, oh man, so that's kind of cool, right? And then you just kind of start to kind of think about what it could be and like going further and further and further into diving deeper into it and investing more. And like that's the motivation to keep going, right? So we got about 15 minutes to go. We may get a new low of the day here. It looks like we got some pressure. Maybe we get a new low of the day. Maybe we do. Maybe we do. Yeah, it's coming down to it. It's coming down to it now. I can get rid of this. This is the May Fed meeting. Let's see. And the May Fed meeting is like 50-50 now for either a 25 or nothing. So that's kind of where we're at. Let's see. What else can I delete? All these things. So yeah, tomorrow's going to be job numbers, jobless claims. See what happens there. Maybe it's kind of chill. And then next week, looking into economic news for next week, some house price stuff, real estate stuff. GDP second revision, so who cares? Shouldn't make a big difference. And for next Friday should be fun. We got PCE numbers, personal income numbers. Okay. So we're kind of like, the next big thing is like next Friday, when we get some good data. So in the meantime, we might be just kind of oscillate around. We have some news that drives us. Looks like a new low on SPY. Yep, just made a new low on SPY just now. Love dividends and income. What do you think he's going? 395 support zone. Man, look at that. It tested it and bounced a little bit right there on SPY. About a 50-cent bounce just there. 60-cent bounce. Hourly chart doesn't look bad. Bullish structure. Let's take a look at the hourly on it. Yeah, I mean, here's the thing. There is a gap to fill, right? This would make a lot of logical sense to me to come into here, fill that gap down to like 394, and then maybe bounce or consolidate there for a bit. So that's kind of the spot to watch. Under that, that looks like even a good put play here. Like this could be a nice put play. Is it the best? Like, does it make a ton of sense? We technically are almost uptrending. Right? You are kind of fighting that trend, but for a short little put play, you zoom the chart in to like a 15-minute chart, and it makes sense. You just don't want to see us if we kind of break down here. You just wouldn't want to see us, popping back up into like 396, 397 zone. You want to see us like kind of stay below that. I would think for this to be worthwhile, right? From a risk reward standpoint, let's do the math here. If you took a short right now into this zone, this breakdown, you're targeting of, let's just say you target 394 on the nose. Okay, take a short right now. Risk would be the top of that. Maybe 396. It's better than a 1.75 roughly, so that's not bad. That's honestly a trade, man. That's a trade idea right there. And we may even just freaking plummet right through that. It's about $1.50 to $1.15 to go until that 394. So if we get that in the next 12 minutes, it'll be sick, because then we kind of fill that gap, and then we can kind of just let tomorrow be tomorrow. It's a weird time of day to go for it, in my view. But NVIDIA is a monster. Check this out. Yeah, the NASDAQ just went down very nicely. The Russell been pretty weak. Check out the Russell. Here's the daily chart on the Russell. Pretty weak. Way weaker than the NAS. The Dow been weak-ish. But here is, by the way, Apple. My goodness. Had a big push today, but look at this level that broke. It just broke this 157.50. That's a big spot. Maybe this thing has a fake out, right? If this could be a fake out, then that would be a nice move, right? But it looked like it broke out nicely on Apple. Microsoft is actually still green today. It looks pretty strong. NVIDIA, look at NVIDIA. 276. I was looking at that 275 area today. I tried a shot on NVIDIA. Ended up stopping me out. The timing wasn't the best. It was it was a small position looking back. It was kind of not dumb. The real spot was here. I was not around to see this, but this is the spot right here when it broke that like 264 this morning. That was the level to watch. I ended up playing it late. Back when we got this push, didn't take profits here, let it come back and kind of go red on me as it broke out there. But honestly, there's not really an excuse there. Should have taken the gains, but then we kind of just had this like slow choppiness decay of options, and it was like, just gonna cut this thing off. Looking back, would it have worked out? Yeah, it would have worked out if I had just let it play the VWAP. Sure. But closer we got to the Fed, like, do I really want to hold this in the FOMC? Like, that's like breaking like 1,000 rules that I've just, no, I'm not doing that. So, but yeah, I mean, I got a SVIX, short the VIX. I'm in there. I have an average in the 13s. It's at 15 something. I have a small position here. I would love to get more. And if we want to dump to lows, great. If not, if SVIX gets back up towards 16, 17, I'm out. Like, that's it. It's just pretty much that's going to be the deal. I think $17 is a good take profit in my view. But we'll see. We'll see. If it comes down, if it makes a new low, great. I'll be buying this thing in the 11s, ideally, and then maybe lower, just taking little chunks. But no reason to go crazy on it. Could do it in the Robinhood. I didn't. But look at that SPY move, by the way. We were looking at that. It looked pretty good. Just was like, you got 10 minutes to go into the end of the day. But look at that. 394.75 just hit. 75 cents to fill the gap. It might have a shot at it in the next 9 minutes. We'll see. But let me get rid of this white zone. The gap fill zone is I'll draw a new one for that. That would be essentially like this. So yeah, hey, it's pretty darn close to filling it, man. Pretty darn close. So maybe it's about, it looks like it's going to fill it now. Geez, that would have been a good trade. Maybe in a futures trade there. That would have been good. Although it is in a bigger picture uptrend on like the 1 hour chart, it's kind of in a SPY uptrend, so it's a little tough to play that. But when it rains, it pours sometimes, right? Elevator up, stairs up, elevator down, and that's kind of how it feels, right? We kind of look how much, kind of just like grind it up a little bit, and then 390 worst case. I think 390 is a pretty key spot. Yeah, that gap just filled, just like that. Boom, gap filled. That was fast. Damn. That was fast on SPY. Let's see if we get 394 exactly on the nose. We're like 5 cents off, 8 cents away. There it is. There it is. 394 just hit on SPY just like that. Jeez. That was fast. That was fast. That was like in friggin' 2 minutes. It seemed like. Jesus. But then again, right, I look at that and I say to myself, well, you play futures, if you played it, right, you would be up huge fast on that break. But if it went against you, you can be down huge very fast as well. Are you comfortable with that type of volatility? If you're not, then just leave it alone, and there'll be other opportunities. But that was it. That was a big move. So gap filled on SPY. We can get rid of this box. I thought that was going to be up there for the night. Nope, that filled already. So there you go. Kind of a massive fuckery, because you had this big move, not big move, but you had a decent move up and then down, then up and then down. So it was kind of like, remember how we always say like the first move is the false move? But it was almost like, yes, please play that. If you're not quick, you're going to get fucked, because the first move, it was the false move. The first move was up, right? It was the false move. But the second move was also the false move, because the second move came down, massive wick back up, make a new high. So if you're like, okay, if the first move is a false move, if you're operating under that thought, then my stop loss is over high of the day. Guess what? You hit your stop loss as we made a new high of the day. So you would have got stopped. You could have gotten stopped out of your shorts, then only to watch the market just dump off a cliff from there. So it's a mental game. It's not easy. And that's why, to be honest, these days, it's like, tomorrow's a great one. Tomorrow will be a great day. Today is fine, but tomorrow will be even better. You can't let it just do its thing. But, the 0 days on this, holy shit. Look at some of these. Let's look at some of these options. I'm sure that there's some crazy moves we could see. If you go to SPY, let's go to today. The 394 area was like our spot, right? We're watching the 394 puts. Check these out. We were watching them like literally a few minutes ago, as this is nuts, as like the potential for the gap fill area. And literally, right, when we break that level, we broke this like right here on the 245. Jesus. So you could have gotten filled on a 394 put around 10 cents at 2:45 p.m. Central Time, okay, 3:45 Eastern. And that would have gone from 10 cents all the way to 137 at the peak. Now, of course, you're not going to catch the whole thing, but just picture that move. 1,200%. You get a piece of that. That's all you're looking for, a piece. Just a little sliver. Would have paid fat. Crazy. But again, no, position sizing has to be, appropriate. But that's the thing. So if you're playing games where you're playing 0 days and you're like, well, I'm willing to let my option lose, 95% of its value. I'll try to salvage it at the end for a few cents, or I'll let it go to 0. I'm willing to let it go to 0 to make 400 plus or 300 plus %. Like it makes sense because you can get moves of 1,000 plus %, like in a very short period of time. And that was an example right there where you got one. Crazy. But there you go. Key spot, right? You had a key spot. You bounced nicely at yesterday's low. Once we broke yesterday's low, previous area that was respected as support broke. Big move. That's the reality of what can happen. Yeah, 10x in a few minutes. And literally a minute. It's not like a couple of days, a couple of weeks. No, minutes, hours, no, minutes. Crazy. I'm curious for tomorrow. We're going to get this, the sentiment data. I would imagine, because the market bounced back a little bit, I would imagine it's a little bit more bullish, my guess, if I had to guess. It's not going to be this bearish, but we'll see. You never know. 3 minutes to go. So close. Are we getting any moves in the 10? Yeah, we are. 10-year coming on down. Come on down to Bob's. 10 years down at 3.44%, which, we came on and we were talking about it at like 3.5. It's down a little bit more. The dollar, let's see the dollar. The dollar's kind of bouncing back a little bit from where the lows were. What about silver? Yeah, silver's still staying up towards the highs. Not really a big move there on silver. Bitcoin, 26.8. So it's fell back below 27. Okay, here's a one-day chart on Bitcoin. To be honest, what did it do? It hit like right up the spot, that I was looking for it to kind of hit. Not that I was trading it, but like, where it just filled back through. Let's see, why is my volume profile not working on this guy? I gotta zoom out further. Volume profile, please pop up whenever you're ready. Oh, why? Study error. Histogram was too large. Please increase the row size input. Let's see. If I want this to like 50, what happens? Is that enough? No? Not enough. Really? I had it at 25. Let's see. What if I did 100? Is that enough? I don't know. That's kind of a shame. I want to get the volume profile on Bitcoin, but I'm pretty sure last time I looked at it, that it was, well, no, you can just tell. I mean, this is a very quick and swift move down. That there wasn't a lot of volume traded during that level on Bitcoin, and so if you were to look at a volume profile of Bitcoin, which for whatever reason is not loading up now, you would see that there would be a lot of room up in here, and then there'd be some heavier volume spikes out here, right? So it kind of did exactly what you want to see it do. It filled that, and now it's rejecting a little bit, which makes sense. It's not like it's, oh my God, I didn't see it coming. I mean, look at this SPY though. My goodness, holy shit on SPY. So those options, they went to 195. You could have bought them at 10 cents on the break of yesterday's low, and they would have gone 1,800% to the highs. Oh my God, that's nuts. But that's the power of options. That is the power of options. 0 days, man. But then again, right, what happens in this scenario, right? Because at this point in time, right, those were 394 puts. Strike price, I'll mark it, was like right here. Okay? You would have bought them here. Well, what happens if we did this? And that was the end of the day. They're worth nothing. They're worth 0. So that's the downside of them. But you nail it. Whew, whew, whew. Killer. 18x. That's insane. What's today, Wednesday? All right. Well, I maybe just do lives the rest of the week. We'll see. But with that, so I'm going to wrap things up. I got a couple things I got to do. Actually, I got a lot I got to do this evening and stuff and just whatever. And I got dentist stuff this week. I got a lot of crap to do. But I got to catch up on all that stuff after being away. And I will see you guys. I'll probably do a live tomorrow, most likely, is my guess. And so we'll hang out there. If you can make it, great. If not, what I'm going to be doing now, and I think this is what I've decided to do, is for people who can't, because I know obviously there's like a few of us on here. Not a lot of people can just kind of watch the lives midday, right? Depending upon work, school, and stuff. Clipping up some of the stuff that we talk about and putting them into shorts and then posting those as well, I think could be a nice way to do it. And that's the plan going forward. To just kind of build out the shorts with, stuff, highlights from our lives. So that's kind of cool. But if you're on the lives, you're going to get it. We're going to talk about it real time anyway. So peace out. Thanks so much for watching, and I will see you guys